Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today we're talking with my friend Simon Ree. Hey, Simon, how's it going?
Really well, Kirk.
Good. Well, glad to have you in the show. So Simon, tell us a little bit about your background.
I've been fascinated by the stock market since I was a teenager. 1987, we had the big stock market crash. I was in my second last year of high school, and I found the whole thing fascinating. I didn't have any money at stake at the time. I was a bit too young, but I was transfixed by it all. Of course, we had Oliver Stone's movie Wall Street was released, I think, the same year. And I had an economics teacher at school who was really into it and kind of inspired me. I had the early inklings that I wanted to be involved in the stock market. Studied economics and finance at university, and then got my first job out of university as a futures broker. And I did that for a little while, but I just didn't find wheat and orange juice as exciting and as dynamic as Microsoft and Cisco and what have you. Eventually, about 3 years later, I made the jump to working on the equity side at Goldman Sachs. And I spent the next 14 years there. And it was during the global financial crisis in 2008 where I had a very powerful learning moment, shall we say. Well, it was more than a moment. It lasted for a whole year. But yeah, I lost an enormous amount of money that year personally. And that was through no fault but my own. But I was listening to who I thought at the time were the smartest guys in the room, the Wall Street analysts and strategists who kept proclaiming that stocks were cheap and a market bottom would soon be at hand. And so I ended up buying the market all the way down and had a pretty rotten experience financially as a result of that. And it was early in 2009, sort of shortly around the time that the market actually bottomed. I was having a beer after work with one of the proprietary traders. These are the very bright guys who trade the firm's balance sheet, and I was lamenting to him my story of 2008 and what an awful year I'd had in the stock market. And I asked him how his year went, expecting a similarly miserable kind of turn of events. He said to me, "Simon, 2008 was my most profitable year trading ever." And my jaw kind of hit the ground, and I thought, my God, how is this possible in a year where the S&P's halved? So a beer after work turned into a long dinner, and I just quizzed him and took a lot of notes, and that one conversation completely changed my approach to markets and how I look at them. And I really swore off fundamental analysis from that day on, and became a technician. Became really devoted to following charts, following price and momentum.
So don't keep us in suspense here, Simon. So what was the nature of that conversation? What were some of the takeaways you got from that changed your whole outlook on things?
Well, it was really just this idea that anything that you read in the paper or read in a research report, it's already there in price. Price will tell you everything that you need to know. It's a lot easier to follow, and with a few simple techniques, a few simple indicators, price will show you the way. Now, obviously, there are no guarantees in trading. It's called trading. It's not called risk-free money printing, but it's all about putting the odds in your favor, right? Yeah, right. Yeah.
So that pretty much turned you into a technician. I know I've had a similar, not for not for that reason, but I've certainly had a similar bent. But I would imagine, I mean, you still use fundamental analysis, or are you just strictly a technician at this point?
No, strictly a technician. I mean, I'm aware of the macro situation. I don't pretend to be a macro trader, but having an awareness of kind of which way the wind is blowing, I think can be helpful. But no, I mean, I don't look at PE ratios or valuations or earnings forecasts or anything like that. I don't think it provides me with any edge at all.
Okay, that's good to know. I remember. I mean, there's a few times I remember the sentiment on Wall Street being completely on one side. I think it was last year at one point that people were convinced that interest rates were going to start going up, and yet they went down, and people were just like, "What's going on? Like, I don't understand why." Why? And so, do you track sentiment, or how does that kind of play into your trading?
Yeah, I do. Well, I mean, sentiment is useful when it reaches an extreme, and I'll track sentiment through things like the put-call ratio. And the put-call ratio is, I mean, it's certainly not foolproof, and it's not a perfect timing indicator, but it's a pretty good sentiment indicator, and it's good because it doesn't tell you. It's not a survey that's exploring how people say they feel. It's showing you what people have actually done. Have they behaved in a bullish way? Have they behaved in a bearish way? So things like the put call ratio, commitment to traders reports, this is where people have actually put money on the line. And when they reach extremes, it can be of interest.
So yeah, so those are two things people talk a lot about. I mean, put call ratio for sure. Although I would imagine that if you're doing spreads, that would kind of alter those numbers a little bit, right? I mean, I don't know how they calculate that, but wouldn't doing spreads kind of alter the nature? Like you could have a put, and at the same point you could be bullish or bearish, even using a put, right?
You could, but what tends to happen, and this has been observed, since options markets have been in existence, is retail or the street tends to buy options, and market makers, dealers tend to be the sellers of options. Not always, but overwhelmingly the case.
Okay. All right. Well, that's good to know. But then the COT report, that one's also interesting to me. Like, watching that, I know a lot of people look at it and they say, "Oh, wow, there's an extraordinary amount of, uh, 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 you know, uh, of futures being traded in a certain way," which would allude that people are bearish. And yet you have the commodities producers, which are also using them to hedge their own exposure, which may not necessarily be what they think the market is going, but they just want to lock in a price. So how does that work on the COT report?
Well, COT report, you want to see what the large speculators are doing. All right, so the people who have a financial interest. Um, it's really when they all jump on one side of a boat. You want to look for the opposite to start happening, not straight away. Like I said, I would never take a trade based on sentiment, but again, it can just give you an inkling as to which way the wind is blowing and whether that direction might change in the near future.
Okay. So, all right. So you named a few: the COT report, the put call ratio. Anything else you look at for kind of sentiment, or I would say macro indicators that are not necessarily price related?
Yeah, I mean, it's just a case of things like being aware of what the Fed's saying, and whether you choose to actually listen to the Fed or not. I mean, a lot of people have heard the Fed but not really listened to them, or maybe it's the other way around. Maybe they've been listening to the Fed and not heard the message. So things like messages from the Federal Reserve, looking at things like what the dollar's doing, what yields are doing, what high yield bonds are doing. What global equity market indices are doing, the various sectors, and you can sort of paint a bit of a composite picture about whether we're in a risk on or a risk off environment, and whether there are any correlations that are breaking down, or unusual things happening.
So yeah, that you kind of mentioned the Fed, and as they just raised rates. Well, depending on when this episode comes out, but last week they raised rates. So one question that kind of comes to mind, and I'm really puzzled by this. So the Fed, in my opinion, has been abundantly clear about what they're trying to do, and I feel like Wall Street, or institutional traders, name it, all Wall Street, seems to completely be ignorant about what they're trying to do. Now, do you feel like that's being accurately reflected in the markets right now, or what are your thoughts about that?
I agree with you 100%. I mean, that people have been calling for, expecting, predicting, the so-called dovish pivot pretty much all year. I don't think Powell could have been clearer in terms of what their intention is and what their course of action is, that they're going to destroy demand until they can get inflation under control. And they're doing that through the only means they have at their disposal, through tightening monetary policy. I think that any optimism about a pivot is misplaced. And when I look at 10-year treasuries yielding at, what is it, 4.15, 4.2%.
Yeah, 4.25. Yeah.
Clearly, clearly the bond market is less enthused about things than the stock market, particularly since that big rally we've seen since the October 13 low. Now, this is where macro and positioning can sometimes be at conflict. I would argue that the macro conditions are really not that friendly towards risk. But again, it appears there's a lot of short interest in the market, and in the short term, the pain trade could still be higher. We've got the midterm elections today, and midterm elections historically tend to show a strong swing away from the president's party in terms of seats in Congress. And if we get that outcome again this midterm, the market would probably cheer the result because it results in political paralysis, so-called gridlock.
Yep.
We've got CPI coming out later this week as well on Thursday, and the market has been incredibly sensitive about CPI prints. If it comes in at 0.1% hotter or cooler, it seems to be worth several percentage points on the S&P 500 at the moment. Now, people, again, they've been forecasting inflation is going to peak. It feels like that forecast has been made by the street for months. We're probably getting to the point now where inflation is going to start looking like it's peaked, whether that's an all-time peak or whether it's just a short-term top. Again, the market is likely to react positively to that news because the perception will be that the Fed have got less heavy lifting to do on the monetary tightening side.
Yeah, no, I've certainly it's hard to believe that we would stay at 8% for another 6 months or so. I think what's interesting to me is, and if you look at the I savings bonds, for example, for the last 6 months, those were 9.62% you could get, and that's no longer allowed. That's no longer there. I think now it's at 6.82, I believe. I'm just going to check this real quick because to me, it was a huge shock in the opposite direction because we still have 8.2%. Yeah, 6.89% for savings bonds. It's almost a full 3% drop, and yet the CPI is still in the same place. So kind of makes me scratch my head like, what do they know that we don't know yet? So,
well, I mean, this might be the first cooler than expected inflation print for many months, and yeah, I think we could see some short-term upside in equities if that's the case.
Yeah, I guess it kind of makes me wonder as you're looking at things like this. Obviously, it's really important, but certainly the Fed is still behind the curve, even if it drops. I don't see it going down to 4% in a CPI. I think that would actually be a little bit of a head scratcher as well. But where do you think things go from here? I mean, certainly the Fed has been a little bit behind, and we've still had persistent inflation. But how do you see this kind of from a big picture perspective? Because it does impact things, right? Like what the Fed does is probably, if I had to ask one question and only one question to determine the fate of the market, it would be, what's the Fed going to do? Like that's all you need to know half the time, right? So
yeah, right. I mean, the control seems omnipotent still. Yeah. How does this play out? Look, I think the message from Jerome Powell is clear. Rates are going to be higher for longer. He's certainly hinting at a terminal rate somewhere north of 5%, even if the gradient of attack is slightly less steep. I think we're in for several years, call it a decade, of much higher economic volatility than what we've been used to. Anecdotally, whenever inflation gets above 5%, it's never come under control until the Fed funds rate has exceeded the inflation rate. I'm not saying if Fed funds rate is going to get up to 8%, but there'll be some sort of crossover point. But if you look at the 70s, I mean, we had inflation had three major peaks. The equity market kind of followed suit, and we just had a whole decade where stocks kind of went nowhere, and there was just a whole lot of volatility. And there would have been moments during that decade where it felt like a bull market, and there would have been moments where it felt like a bear market. And at the end of the decade, really, in no progress. And I think we could be looking at a similar decade here. high economic volatility, high financial markets volatility.
Okay. No, I definitely agree with that. I would agree. We have at least 10 years of that, and not looking to 30s yet, which could be a whole nother ball of wax, which I don't want to get into at the moment. But no, I like your thinking in the 1970s. I think there's a lot of similarities to it, and I don't know how much you've studied the 70s, but like, are there any kind of correlations we can draw from that we can pull into what we're seeing today?
I mean, I guess the biggest difference would be debt levels. All right, the total debt to GDP is double what it was, or more than double what it was in the 70s, and so that kind of, I think, it constrains the upward movement on rates. We're not going to see rates up at 18%. You probably find, I don't know, 6 or 7% is the new 18%, given where debt to GDP ratios are relative. But for all this talk of inflation is transitory, I think that's been proven pretty much wrong now. And even though things like shelter and other components, major components of CPI, car prices are starting to moderate. We had a 30-year deflationary tailwind there as a result of globalization, and the process of reshoring and deglobalization, I think, is still in the very early days, and that's going to add a real stickiness to inflation that we've really yet to see materialize.
So have you kind of considered the real estate market at all, and the impact that's going on there? Because that also seems to have a discrepancy between price and affordability.
Well, I mean, real estate market is just really tough in the US at the moment because obviously mortgage rates are north of 7%, but prices haven't really come off much yet. I mean, we've had 2 consecutive monthly declines on the Case-Shiller, but they're still well up there. So yeah, housing affordability right now is a real issue, and yet the market's kind of gone no bid because nobody wants to take out a mortgage at 7% plus. I think housing is looking increasingly fragile, and ultimately, if there's any sort of distressed selling, if we do see layoffs start to increase and people have to sell their house because they can no longer afford even their current mortgage, we really could see some fragility there.
Okay. So, you know, how should somebody look at these? I mean, given the things that we're talking about, I mean, obviously these things are not altogether positive, but how should people look at these markets, and what's the way they should look at investing or trading in them? Because I think most people have a buy and hold mentality, which, will not work well in bear markets. So how should people be looking at this from kind of like a mental framework perspective?
Well, I think a lot of people they approach markets with this question of where should I put my money? Should I put my money in stocks? Should I put my money in bonds? Should I put my money in real estate? And okay, real estate's probably worked out okay. Stocks and bonds have worked out really badly this year. Bonds have had, I think, their worst year on record. There've really been very few places to hide. Crypto, anyone who's put their money in crypto has been burned. So where do you put your money? And I think it's perhaps not the right question to ask. And this idea of I need to just put my money away somewhere and sit on it. It results from having a fixed mindset. And if you adopt more of a growth mindset to this question, this problem, you might reframe the question. Instead of asking where should I put my money, you should say, well, how can I identify high probability moments in time to put my money at risk, rather than having my money at risk all of the time, which is I guess the traditional approach. You just put your money in a bunch of ETFs and then look at it again in 10 years and hopefully you've made some money. The next 10 years just may not be so kind, is my concern. And we've had several 10, 15-year periods in the market where stocks have done nothing. The lost decades are not that uncommon.
That's going to shock a lot of people, I would think, in that they're expecting 6-7% a year in their portfolio, and they're going to end up getting a goose egg at best in some cases. So it, because the 2013 was the same period. We lost 13 years of sideways market. The market was down for 13 years. I mean, Japan's been close to 32 years. They've been below the peak since 1990. So it's not to say that it can't happen here, but it kind of makes me wonder, like, how should people? I appreciate the growth versus fixed mindset. I think that's a huge starting point. But how can people like focus on these higher probability opportunities? Because most people are looking for a simple way to invest. They don't have time to analyze things like you and I do.
Yeah, it's true. And in order to be able to do that, it does require some time commitment. You need to educate yourself. So I teach people how to trade. I teach my approach to trading using technical analysis and following price action. And it's all about identifying those high probability moments in time. So my default position is cash, and I'll never be more than 50% exposed to risk. And really throughout much of 2022, my risk exposure has been a lot lower than that. But by using options, you can manage your risk, you can gain upside leverage, and provided you get your position sizing appropriate, which is really, really critical, you can make very useful gains while only taking a small amount of risk. And you might only put your money at risk for very, well, relatively short periods of time. My average holding period on any options position is really anything from 2 or 3 days to 2 or 3 weeks. And that's become a little bit shorter this year just because markets have been more volatile. But really all I'm looking to do is just book incremental gains. I'm not looking to earn my retirement on any single trade. I'm just looking to earn lots and lots of base hits, as you might say, and add them all up at the end of the year.
So let me ask you this, because option trading could be, I mean, there's so many different ways that people trade options. Kind of what's your preferred style? Like, do you have certain frameworks or styles that you tend to follow with option trading?
So my preferred style is trend following. Trend following is easy, it's simple, it's visual, and it's very easy to know if you're getting it wrong. So that's yeah, I'm a trend follower at heart. But I think in a market like this, it's important to combine trend following with counter trend trades where you are actually looking to identify market turns. And the reason I say that is because in a bull market, most things tend to grind higher, and bull markets tend to be a slow, ponderous, happy/bored environment for investing and trading. Bear markets have a very different personality. It's sort of a bit like Dr. Jekyll and Mr. Hyde. The bear market is Mr. Hyde, where you get very sharp reversals and trend changes can occur seemingly instantaneously. So I find combining trend and counter trend approaches very, very powerful in this sort of environment.
Okay. Do you have, I'm curious, are you using spreads? Are you just kind of buying calls or puts, or do you have kind of a theme there?
Yeah, I trade a lot of spreads. So if I'm looking at something directional, like a trend trade, I'll do a debit spread. And if I'm looking something counter trend, where I'm expecting a stock to not go up anymore or stop falling, not go down anymore, I'll trade credit spreads.
Okay, cool. Now, when you're, what's kind of, do you have a target, or are you when you put on a trade, do you have, you said you trade between 2 and 3 days and 2 and 3 weeks. Do you have like a target price or a target that, when you go into a trade, or how do you kind of like set up your trade?
So for a trend trade, I want to get in as close to the mean as possible. So what I'm looking for is for price to get back to the mean. And for me, the mean is the 21-day exponential moving average. And then I'm looking for price to expand away from the mean again with the trend. And so what I'll do is I use average true range as a profit target. And generally I'll look at 2 average true ranges above the mean as like a low hanging fruit kind of easy profit target. And that's where I'll start to scale out. And then usually by the time we get to 3 average true ranges above or below the mean, depending on whether it's a bullish or a bearish trade, I'm usually out of the position. And that's because I'm not trying to hit massive home runs. I'll do that very, very occasionally, but normally I'm just looking to book incremental gains.
Okay. So do you have, you said you're looking to have kind of base hits instead of home runs. How are you how are you putting together your position sizing? And then do you have, in terms of a base hit, what does that look like? So I guess um the money at risk or the percentage per position, I think would be interesting.
So normally I'll risk a maximum of 5% of my NLV on any one position. And if I make 50% on that options trade, if you don't trade options, that probably sounds like a ridiculously huge gain, but it really isn't. That's 2.5% of my NLV. All right. And I'm targeting to make 5% per month on my NLV, my net liquidating value, my portfolio value. So if I risk 5% of my NLV and I can make 100% gain on one trade, that's job done. And usually I'll come out of that position and that's my target for the month. It doesn't mean I'll stop trading for the month, but I'll certainly stop trading for the next 48 hours and then be very deliberate about any other trades that I put on.
Okay. So do you have like one trade you put on at a time, or do you do how many trades do you do at a single time?
I mean, I will sometimes put 2 or 3 trades on at once. I generally won't have more than 10 positions open at any one time.
Okay, cool. All right. So, when you look at risk management, how do you look at that concept with your trading?
So I look at position risk management and portfolio risk management. So position risk management, it's all about getting out of a position uh, at a manageable loss before it becomes a big loss. So as soon as something unexpected starts to happen, I'll cut the position. I'll assume I'm wrong. I love a quote from Paul Tudor Jones. He says, "Every day I get up and I assume all of my positions are wrong until the market proves me right." And I think that's a useful framework for position risk management. So if the trend starts to change, I don't sort of wait for it to kind of end up. I don't wait to see if it does end up moving back in my favor. I just cut the position because I can always get back in. And let's face it, transaction costs these days are nothing or next to nothing. And then I look at portfolio risk management. So I've got a very hard and fast rule. If ever I have a portfolio drawdown of 15% from a high watermark, I cut everything and go to cash for at least 24 hours. And the reason I've chosen 15% is because to get back to break even, I've only got to make 17.5% back. And I know I can do that because I've done it many times before. If you end up losing 50% of your portfolio value, you've got to double your portfolio just to get back to break even. And that's a very, very tough psychological position to put yourself under.
Yeah. Yeah. That, that is very challenging to get out of, especially anyone who's been through 2008, 2009 and saw it, it's close to 60% drawdown
Yeah.
from that period.
It's a very deep, dark psychological hole to try and dig yourself out of.
So now you mentioned you invest in ETFs and stocks. I'm curious in this environment, given what it is with, earning surprises and, really a big paradigm shift from where we were in the last 40 years. How do you choose individual stocks? Like, how do you go about that process?
So I've got 3 or 4 trading setups that I use, and I've set up scans. I scan on some very particular technical criteria. And then it's just a case of eyeballing the charts and making sure that what's come up in the scans actually makes sense on a chart as a potential trade. But the scans save a heap of time. So, I may only have to analyze half a dozen or a dozen charts a day, which, when you've been doing it for a while, that's sort of 5 minutes work.
Yep. Okay. Do you have certain stocks or ETFs that you trade a lot, or are you just kind of agnostic with all that?
Well, I mean, it changes over time. I mean, if you go back to 2017, 18, 19, 20, 21, it was big tech. It was Netflix, it was PayPal, it was MasterCard, Microsoft. They were just all amazing trading stocks. And then you had all of your kind of your loss making, high flying, high beta tech stocks that the sort of stuff that ARKK owns. A lot of that was very fun to trade during that period. But during 2022, I mean, a lot of those stocks have been, I guess, still fun to trade, but from the bearish side rather than the bullish side. On the bullish side, obviously, energy has been great. Healthcare has been pretty decent. Banks more recently have had a pretty good run. But it's just about being in tune with what the various sectors in the market are doing, and I look at the sectors every week just to see what sort of phase they're in, and again, it's just an indicator as to which way the wind is blowing.
Okay, good. So I know you mentioned before the show you have this thing of the 5 big myths of Wall Street. I'd love for you to kind of touch on that, because we also talk about the Wall Street myths as well. Like, there's so many of them, so I'm curious on what yours are.
Yeah, well, I mean, my favorite one is this notion that a 10% per annum return is an amazing return. I mean, 10% per annum is roughly the long-term average annual return of the S&P 500. All right.
Is
I
it
think,
still?
well, I haven't checked this year, but yeah, it's probably down a little bit. But basically, that's a return that somebody who's managing money should be able to achieve for you, through a market cycle, pretty much dancing on their head. So that's probably one of my favorite myths. Of course, Wall Street wants people to believe that because they then get to charge people a whole bunch of fees for not doing very much and just managing the money. Like I said, I mean, my target return is 5% per month, and I've got members who are doing much better than that. And 5% per month, if you compound your gains monthly, that works out to more like 80% per annum. And these are the sorts of returns that people can achieve if they're prepared to put in the work and spend 20 minutes, half an hour a day looking after their portfolio. Sorry, go on.
Yeah, no, I was going to say that to me, you make it sound easy, but there's a huge mental shift in learning this. It's not as simple as just putting numbers in a box. Like, you have to learn a lot of stuff to be there, or most investors would be that good, right? Like, it's not that simple, right?
Yeah, there's effort. All right,
Yeah.
there is effort required, and it doesn't happen overnight either. I mean, it could take you weeks, if not months, to start approaching that, and that's with effort involved, which is why so few people achieve it, because they can't be bothered getting started, or they get started and they don't hit home runs in the first 2 weeks and they give up. And for some reason, trading it's a profession that a lot of people they just approach it with this lotto ticket mentality. And it's quite funny when I talk about returns. I don't normally like talking about returns because I usually get one of two reactions. One reaction is, "Oh, 5% a month, that's impossible. No one can do that. Only Bernie Madoff can make returns like that." The other reaction is 5% per month. Why would I bother if I can't turn my $5,000 into $2 million in 6 months? What's the point? So, whereas to me, it's a good number. It's achievable with effort, with education, with practice, and the returns, like I said, over 5 years can be life changing. If you invest $5,000 and it earns 10% per annum, 5 years time, you've got about about $8,000. All right, which is not bad.
Yeah,
if you got
better than a sharp poke in the eye, right?
Yeah, if you got $10,000, you invested at 10% per annum, 5 years time, yeah, you got about $17,000. But if you take that same $10,000 and you invest it at 5% per month and compound it monthly instead of annually, you end up with about $330,000 at the end of 5 years. So the returns profile, if you stick at it, is vastly different.
Yeah, I think there takes quite a bit of mental discipline to do this, right? It's I think
it takes mental discipline, and but more than anything else, it takes commitment. You've just got to show up and do the work every day.
Yeah, no, I couldn't agree more. Every successful trader I've ever met, they have a tremendous amount of discipline and consistency, right? And stick to itiveness, because sometimes things don't go your way, and you gotta get out of that hole, right? I mean, I'm sure you've got your, as they say, some traders, they have their white whale, their stock, every time they touch it, it just goes down. Like it just doesn't do what you think it's going to do. And they just, once they know it's kryptonite, they just stay away from it.
For me, that's the whole biotech sector.
I think that's the same thing for everybody, by the way. Well, cool. So I know we're getting close to wrapping up the show. Maybe you can share one more of your myths, and then we can kind of get close to wrapping up here.
Yeah, I mean, another myth that I love is this concept that high risk equals high returns, and Wall Street would have you believe that you've got to increase your chances of losing if you want to win more. People don't, I think, necessarily think about what risk really means. The word risk kind of got co-opted by the finance industry to mean volatility, but if you think of risk in terms of what it actually means, risk is permanent loss to your capital. You're not going to increase your chances of winning more by losing more. So I like to take a low risk, high returns approach. And I think taking a low risk to trading is a much more sensible path to improving your return profile.
Yeah, no, I love that. You just you just touched on two of mine too.
Right.
Risk versus volatility, and the high risk equals high returns. Actually speaking at a conference in a few days, and one of the slides is basically showing that, like, Illinois municipal bonds, high risk, low volatility. Then you got U.S. Treasuries, mid volatility, low risk, and then you've got this year, which is everything's high risk, high volatility.
Right.
So it's interesting. So Simon, I really appreciate you sharing your wisdom with us. Can you leave us with some final thoughts, and then where can people find more about you?
Yeah. So look, I think that the next several years are going to be really disappointing for buy and hold investors. Depending on, if you're nearing retirement, depending on when it is you cash out, you might get lucky or you might get really unlucky. I wouldn't leave such decisions to luck. I would encourage everyone to get a quality education on how to trade. You can start small, just start with a very small percentage of your account. And once you've seen the possibilities, once you've proven to yourself what you're capable of, what usually ends up happening is people start allocating more and more of their account to their trading account. And then you might end up like me one day. I actually don't have a long-term portfolio. All of my risk capital is devoted to trading. That is money that I keep in the market. I've got investments outside of the market in, property and physical gold and things like that. But yeah, I don't have a long-term stock portfolio anymore.
Great. Well, Simon, I really appreciate you sharing your wisdom with us in the show. And
It's been a pleasure.
Yeah. And where can people, if they want to learn more about trading, where can they go?
Yeah, look, so you can follow me on Twitter at Simon_Ree. That's SIMON_REE. My website is www.taooftrading.com. And what I'll do, Kirk, is I'd like to offer your listeners a special offer on my educational programs. So if they head over to Tao of Trading, that's TAOOFTRADING.com/money tree. They'll find some resources there. They'll be able to download the first chapter of my book for free and get a hefty discount off our education programs.
Nice. All right. Well, I appreciate that offer, Simon. I will pass that along to our listeners. We'll put that in the show notes. and as well as the posts. And Simon, once again, really appreciate you coming on. I'm sure we'll have you back on again, as the world is going to keep changing, and we're in this new paradigm, and Wall Street still hasn't figured it out yet. So really
I couldn't
appreciate
agree with
you.
you more.
Yeah. So thanks again for joining us, Simon.
Been a pleasure. Thanks, Kirk.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. Mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist, because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room, as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right. Well, that was a great interview with Simon. Really appreciate him coming to the show. He was just a wealth of wisdom that I think we can all learn from. Now we're on to the panel portion of the show. We have our very own Megan Gorman. Hey, Megan.
Kirk, it's just you and me today. How you doing?
It is. It's great. It's great to have just you and me. We're taping right before Thanksgiving. I know this doesn't come out till just before Christmas, but this is when we're taping. So yeah, it's great. Great to have you on. And yeah, I guess more Megan.
Yeah, exactly. It was a really good interview. A lot there. I'm sort of curious because usually I get the question first, so I'll spin it around, right? So you did the interviewing. What was your big takeaway?
Well, I think, I always love talking with guests that have kind of different perspectives of trading and investing, because, we all have our own investor psychology, which we talk about on the show. And I think it's kind of hard to look at somebody like Simon or Warren Buffett, not to compare the two, or, Carl Icahn or any of these people, and just say, wow, I want to be like that person. They're successful and investable like them. And you can't, because they're not you, and how they're wired is different than how you're wired. Some of these people do it full time. Some people do it an hour a month. And I think the challenge is to figure out, what the best investor psychology is and match it with the best investment style. You can't really change your psychology. You can a little bit, but not too much. But you can change your style. So what's really important is understanding your style and what works for you. So we bring on a lot of these people just so people can get a different perspective on trading, investing, and see what's the best strategy for you to be successful. So I like somebody like Simon because he comes from a traditional Wall Street background. He's got a lot of experience in Goldman Sachs, the futures trading desk in Citibank. And here's a guy who decided to get back into trading, as kind of a full-time gig and to educate people. So I really love when people do that, because most of the successful people you find, they made a lot of money and they're just trading their own money, and they just kind of disappear into the background and just kind of do it for, to make a few bucks. But here's a guy who came back and is trying to give back to people, which I really like. So, I I like the interview. I think there were a lot of great takeaways from the interview. I don't want to get into them all now because we'll get into it with our conversation. But yeah, I like the fact that this guy has a similar strategy to me in terms of vehicles. Like he uses options a lot, ETFs, which which I like. I don't have the same style. I don't have the short term nature that he does, but I think the vehicles I really like because it's hard to you don't find a lot of people with that skill set. So I don't know. What were your thoughts, Megan? What were your takeaways?
Yeah, no, I agree with you. First of all, I thought the interview was interesting because it is nice when you hear an investor who has a very strong sense of who they are as an investor, right? And so, I thought it was really interesting. And, it made me think about my client base and how I work with clients, because so much of what I do with clients is more traditional investing, right? Investing for the long term, asset allocation, and so on. And I was thinking through it in the sense of, when do we ever factor in trading with investing the way we do with our clients? And what's really interesting is we don't do it a lot, but there are some moments where we cherry pick to bring trading to clients. And one of those has really been in working with clients who have large single stock positions and giving them introduction to the option world. So a lot of my clients are corporate executives. They're pretty conservative. When they're working at their companies, they can't do option trading. So it's not something they learn about. But once they retire and they're looking for income, right, and that search for yield, which has gotten a lot easier over the last couple of months, layering in trading strategies like covered call strategies is sort of an eye-opener for them. And what's interesting in watching them navigate this psychologically is you're taking someone who you've told focus on the long term, focus on staying in the market, riding the wave, and hey, we're going to do this sort of tactical thing with trading to generate income. And so what I liked about the interview is I think that you need to know who you are as an investor. And even if you are just a long-term investor, there are moments where certain trading aspects can layer something interesting into your portfolio to help you achieve some sort of goal that your portfolio is looking to do.
Yeah, no, I like that because I think there's some different perspectives here. One is I think a lot of people who trade tend to trade the same type of vehicle, whether it's futures or stocks or options or whatever it is, and they tend to stick to that vehicle because they understand it. And which is great. I think that is a smart move because if you start bouncing around, you do things you don't understand. I mean, options are highly complex if you get into it. I tend to keep things simple. Some people get really into the weeds with it, the engineer types that really enjoy the numbers. So I think, it's smart. But as you said, like these vehicles are there for a reason. If you have a stock portfolio and you can add covered calls or potentially puts to manage risk in the portfolio as a whole, I mean, they're great vehicles to explore because it allows you to do things that may fit your thesis on the market, right? I have a very strong thesis. I'm sure you have a strong thesis on the market, Megan, about where you think either things should go or how people should be investing based on where things are. I know personally, I like managing risk with options because it allows me to say, all right, I think there's a potential the market could go up or it certainly could go down a lot. How do I manage a position around that? Because normally if you think the market's just going to go up forever, you just buy and hold, right? That has been the strategy for the last 40 years. However, if you think, hey, we're getting into a rough patch, maybe I want to manage risk a little bit more than normal. But I also think the market could go up. How do you do that? Well, you either buy or you don't buy, right? That's the traditional way. But, some of these other vehicles give you optionality to choose both, which kind of comes back to the framework of the markets do one of three things. They go up, they go down, or they go sideways. Now you think, well, that's so simple. Yes, it is. But which one are you investing for? Most people invest for up. They don't invest for down. I shouldn't have done that. They don't invest for down. They don't invest for sideways. So if you're looking at that, you can invest for one or two, but you can't invest for all three. So you have to decide which is the one that you're giving up. Are you giving up potential downside? So let's say you're investing in dividend stocks. You're investing if the market goes up. If it goes sideways, you're making money in dividends. If it goes down, you're losing money, right? Or if you're investing in, let's say you're buying like call options. Well, you do well if the market goes up, you do well if the market goes down, and if it goes sideways, you kind of lose out a little bit. But you have to know going in which you're accounting for. Because if you think the market's going to go down and it goes, down or sideways, you could come up with a strategy for that, or up or sideways, or up and down. If you assume you're giving up sideways, you can choose any of them and come up with a strategy for them. But I think the understanding is, what problem are you trying to solve for, right? In some ways, I mean, I'll get to you in a second, Megan. I see you nodding your head there. We're problem solvers, right? And that's part of our role, is to solve this problem. So go ahead, Megan. It sounded like you had something to say.
No, I was just nodding in agreement with you, because I do think it's trading is often used to achieve goals. I was just nodding in agreement with what you were saying.
Yeah. So I think, I think it's important. I think a lot of us go into things like a casino mentality. Hey, throw my money on red and let's see what happens. Okay, well, that's gambling. Now, I just interviewed yesterday Annie Duke, who we're having on the show. I don't know when this is coming out, if she's been out or not on the episodes, but we had a great interview with her, and we were talking about how people look at the markets, the psychology of it, and more importantly, how life and how investing is related to poker. In that you have this Rubik's Cube that you're trying to solve. And in investing, it's always changing. So you're never really going to quote unquote solve it, but you have to look at investing through a different lens than you look at gambling, as an example, right? Gambling is just taking a bet and let's see what happens. You could play poker and it's not gambling. It could be trading. It's very similar to trading, where you're looking at a scenario saying, what are the odds? What are the probabilities for success? How much do I put on this trade? How do I, if I'm on a losing streak, how do I mitigate my losses? Like, all of these principles that traders use are the same people poker players use. So you see these people win the World Series of Poker over and over again. It's because they understand the mentality. One of the first guys that I remember from Wall Street that won the World Series of Poker was a bond trader. He won it.
Well, and by the way, a lot of the most famous traders, like Stephen Cohn and everything, are amazing poker players. So there's something to it in that sense.
Yeah, I mean, it's like they're on the trading desk. They're basically playing poker with people on the other side of the trade all day long, and they're making these calculations in their heads. So when you're just putting cards down, it's simple for them. And certainly you get a run of bad luck or good luck, but I think the idea is to look at investing or trading differently, not in the traditional lens that we're all taught, but in the lens of, wins, losses, probabilities, looking at it differently. And this is why I like bringing traders on, because they talk about these things. They talk about risk management. They talk about portfolio sizing. What are you going to do if the market goes against you? All of these things are really important. So, I just kind of wanted to point that out. But, I know, Megan, when you're working with clients, you probably have a lot of investing rules that you educate them on, but also use for them to make sure that they're staying on track. So what are some things that are really kind of top of mind for you?
I think that what is really important with working with clients for me is their ability to understand strategy, right? And I think you brought up right now where you said about gambling. I have, over the years, run into people who feel that investing is gambling, and it isn't, right? Investing is a means to achieve a certain goal. And for most people, it is to have their money keep up with the cost of living and to grow at a reasonable rate of return, right? 5, 6, maybe 7% annualized if you do it right over the long term. So when I start working with clients, I'm very focused in trying to understand what their money experience has been so far and how they view the markets, right? And seeing if they can follow a strategy, because strategy is key here. So for instance, it's not uncommon when I start working with a client and their portfolio that I'm running long-term numbers, right? How do we get to retirement? How do we get to be able to pass wealth on? How do we get to make sure that at age 100, there's still money left there? And that's by using, historical rates of return to figure that out. And that often drives the asset allocation. And so what I'm looking for the client is the buy-in on that, But then the onus becomes on an annual basis to look at the portfolio allocation, to look at the portfolio return, see how it's done, and see, does it tie back up into strategy? And so where I get sort of nervous with clients is ones who want to chase the current trend, right? They have a friend that told about this, let's go throw money there, let's go throw money there at something else. What I want to make sure is that they have a core portfolio that is focused on achieving goals. And if they want to do something like trading, oftentimes I'll say, have a little sidecar account that you have fun in, right? Go do that. But the core investing, it's going to be boring, it's going to be slow, and it's going to be very targeted at achieving a return.
So how do you manage the psychology of clients when it comes to trading or investing, either one? Because I'm sure you get a lot of different variants with different people and how they look at things.
You know, I work with corporate executives who tend to be more conservative by nature, but all of us have money anxiety. Trust me, I have money anxiety, and my husband would tell you my anxiety hits a peak at about 2 a.m. at night when I wake him up because I'm worried about money. So one of the things, and this is basic therapy, is talking, right? I talk to my clients a lot. I feel that it is really important to constantly be engaged in a conversation. So for those of you out there who are looking to work with an advisor, I think one of the intangibles that advisors bring, and it's incredibly important, is you have someone who, whether it's on a phone call, a Zoom, in person, you can talk to at all times. And Kirk, I'm assuming you talk to your clients quite a bit.
I do. We do a lot of upfront conversations. So I think, when we start working with new clients, a lot of what we do is we spend a good amount of time up front. And I know sometimes that's frustrating because people are ready to go and they want to do something today. And it's like, well, hold on. Like, we need to kind of talk through this, because if we're at odds psychologically, then the relationship just stays that way. So we put a lot of time in up front to help educate people and to make sure they're on the same page, because, we don't want to work with everybody. Like, some people are just, they're gamblers. They want action all the time. And just like, we're not a good fit. Or they want to make 30% returns a year. I'm like, I don't know if anybody's a good fit, but but I think the education up front and aligning. So I'll give you an example. So I hear this a lot when I talk to people, and it's usually like one of two things. And it's usually, this is an extreme case, but it does happen. They say, well, I'm really conservative. I only want 25% returns a year. Well, that's not realistic. Or they say, I'm really aggressive. I want 4% a year. Now, the conversation is usually, it's not around whether one is right or wrong. The question is around that, here are your expectations, and here's really where they should be. So, if you have an aggressive risk profile, it doesn't mean you have to take a lot of risk. If 4% is fine, maybe it just means that you have a lower risk profile, or it means that you don't understand where it is in the spectrum of normal, right? And I'm not saying that we're in anything but normal right now, but I think aligning those expectations with reality is an important starting point. Because if I were to just say, okay, whatever, like a lot of, advisors, I know you don't do this, Megan, but like a lot of other advisors say, all right, whatever, just sign the forms and we'll get started. Then that sets the relationship up for failure, because the whole time they're thinking, well, I want 30%. And some advisors saying, oh yeah, I'll give you 30%. You'll be fine. Last year was up 50. It's silly. And then they just complain and they get upset. And it's like, it's just, the expectations were poor to begin with. So what we tend to do is have a lot of conversations around expectations, say, here's what you should expect. And if it's not to your liking, then either you need to change the expectations, which is part of the conversation, or maybe we're not a good fit. And that's okay too. Like, I don't need to work with everybody. I have friends that I could send them to that maybe they're a better fit for them. But I think what's important is that people are working with an advisor that is able to work with them within their expectations, or whatever's realistic for them. Because some people, if you want 20, 30% a year, you're not going to find anybody that's going to make you happy. And you're going to bounce people to people. I remember we talked with, I forget his name, Teitelbaum, I think Stanley Teitelbaum, where he talked about how he worked with an advisor and his expectations were way off from where the advisor was. And he spent the whole conversation and is in the future part of his life trying to figure out like how to align the psychology correctly with investing. And I talk to so many people who are just misaligned, and they will not take any answer other than what they want. And they'll constantly be unhappy. And it doesn't matter who they're with. There's no advisor that's going to make them happy because their expectations are unrealistic. So that's a big part of the intro, is getting through that psychology and making sure everyone's on the same page, so that when we have future conversations, there's no misunderstanding. Here's how we're thinking about it. Here's why we're thinking about it. Like, here's, like we talk on the show a lot about inflation. We're going to have high inflation. If you're watching the news and think, oh, it's going to go down in January, and it doesn't, like, I've told you it's not going to. And if I'm wrong, I'm wrong. But we're at least having the conversation about what we're doing and why. So if there's a change, so let's say inflation does go down in January, which would be hard to imagine. Let's say it goes way down. Okay, now we have to change our strategy. Okay, here's how we should be thinking about it today. But if those conversations don't happen, then people wake up and be like, well, wait a minute, what's going on? And I imagine a lot of people are like, hey, why is my portfolio down 20 to 30%? Well, every single asset in the market is down 20 or 30%. That's why. But if you haven't had those conversations, then you don't understand why things are happening. So I think that the conversations and the setting of expectations is really important at the beginning of any relationship.
Agree 100%. It really, really is important. And it's also, you said it, you touched on it. It's about finding the right person to work with. It is a chemistry game. And it's really about finding someone you can feel comfortable with. So, those are the things I think I look at when I'm starting to work with new clients as well.
Great. So we're going to wrap up this episode in the interest of time, because I know it's the holidays here and we only get to Thanksgiving. So, Megan, final thoughts, and where can people find more about you?
Yeah. So I just, I brought up something at the beginning of this, and Barb would be aghast if I didn't define it. So I will do my Barbapedia as I wrap up today. I meant Megapedia, right? I mentioned at the beginning, I have clients do something called a covered call strategy. And so there are a lot of different strategies out there, but just to define a covered call strategy for our listeners, a covered call is when you sell someone else the right to purchase a share of a stock that you already owned. So that means it's covered, right? In comparison to being naked. So if I wanted to, if Kirk owned, shares of a stock that I wanted to buy at a price, I can pay him a premium. And if we hit that price, I can call the stock away, right? And where people like that is you can take an income on the premium you get, and then you might get the stock price you want to sell at. And if the price never hits that point, the position closes out and you keep the premium. So it's a very, very appealing income generation for people. But how we mitigate risk in it is we make sure it's covered. You own the underlying stock before you sell the call on it. So anyway, Kirk, thanks for having me on. I'm Megan Gorman. You can find me at Forbes.com/Megan Gorman. And everybody have a great Thanksgiving.
Thanks for coming on, Megan. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.